Welcome back to the Plan Future Insight. What a wonderful question. This is the exact starting point of every successful wealth journey. Risk profiling is not just a formality. It is the foundation that ensures your investment plan is built for you, not for someone else. Let me break this down simply. First, understand the two pillars of risk profiling. It is a balance of two critical dimensions. Risk capacity is the head, the objective measure of how much risk your finances can afford to take. Risk tolerance is the heart, the subjective measure of how much risk you can emotionally handle without panicking. A mismatch here is the number one reason investors fail. A young person with high capacity but low tolerance will panic sell in a crash. Now let's analyze risk capacity, the objective math. We assess four key factors. Your time horizon is first. When will you need this money? Short term, under 3 years, means very low capacity. Medium term, 3 to 7 years, means moderate capacity. Long term, over 7 years, means high capacity. Second is your financial stability and dependence. A steady income with an emergency fund means higher capacity. More dependence often means lower capacity. Third, look at your existing assets and liabilities. Strong net worth means higher capacity to take equity risk. Fourth, consider goal criticality. A non-negotiable goal, like a child's college fee, means low capacity. An aspirational goal can have higher capacity. Next is risk tolerance, the emotional check. Ask yourself key questions. If your portfolio falls 20% in 3 months, what would you do? Would you panic and sell? That is low tolerance. Would you hold and wait? That is moderate tolerance. Or would you see it as a buying opportunity? That is high tolerance. Also consider your investment experience and your primary personality. Are you a guardian, a balancer, or an explorer? In my experience, most people overestimate their tolerance during a bull market. Your true tolerance is revealed only in a bear market. Now combine your capacity and tolerance to find your profile. If both are low, you are conservative, with a recommended allocation around 20% equity, 75% debt, and 5% gold. If you are moderate in both, you are a balancer, with an allocation around 60% equity, 35% debt, and 5% gold. If both are high, you are aggressive, with an allocation around 85% equity, 10% debt, and 5% gold. My golden rule is this: your final asset allocation should match the lower of your capacity or your tolerance. Here's what you can do this week. Step 1, conduct a self-assessment. Write down your top 3 financial goals with timelines. Honestly answer the capacity and tolerance questions we discussed. Step 2, create your allocation blueprint. Based on your assessment, choose your archetype and its target allocation. Step 3, implement with a professional. Take this select the right regular plan funds and set up automated CPs, your ultimate tool for managing risk. Dada's wisdom for today. Knowing your risk profile is like knowing your shoe size. You would not run a marathon in shoes that are too tight or too loose. The right fit ensures you can go the full distance comfortably. The market's journey will have bumps, but you will be prepared. Remember, investment in the equity market is subject to market risk. We do not claim any guarantee of return in equity-related investments. Past performance is not indicative of future results. Stay steady.
Investment Dada Wisdom Session. Risk profiling is not static. Revisit it every 2 to 3 years or after every major life event: marriage, child, new job, inheritance. The regular advantage. This is where a trusted MFD, mutual fund distributor, becomes your financial bodyguard when markets crash -30%. Your emotions will scream, sell. Your MFD is the calm voice reminding you of your long-term plan and risk profile, preventing the single biggest wealth-destroying mistake: panic selling at the bottom. The bucket strategy. Align your risk profile to goal buckets. Your retirement bucket, long-term, can be aggressive, while your next car bucket, 3-year, must be conservative. Dada's action plan for you. Step 1, the self-assessment. This week, 1. Write down your top 3 financial goals with timelines. 2. Honestly answer the capacity questions: horizon, dependence, debt. 3. Take the tolerance test above. Be brutally honest about your 2008-2020 crash reaction or imagined reaction. Step 2. The allocation blueprint. Next 1 month, based on your self-assessment, choose your archetype from the table above. That's your target equity, debt, gold allocation. For example, if you are a moderate balancer, your target is 60% equity, 35% debt, 5% gold. Step 3. Implement with a professional. Next 3 months, take this blueprint to a SEBI-registered mutual fund distributor, MFD. They will validate your self-assessment, help you select the specific regular plan mutual funds that match your allocation. Set up automated SIPs, the ultimate tool for managing risk through rupee cost averaging. Be your guide for annual reviews and rebalancing. Dada wisdom of the day. Knowing your risk profile is like knowing your shoe size. You wouldn't run a marathon in shoes that are too tight or too loose. The right fit ensures you can go the full distance comfortably. The market's journey will have rough paths and smooth trails. Your risk profile is the shoe that lets you finish the race. Personal encouragement. You are asking the most important question before investing a single rupee. This thoughtful approach already puts you ahead of 90% of investors. Building wealth is a marathon, not a sprint. Getting this foundation right means you're building a house on rock, not sand. I'm genuinely proud of you for starting here. Let's build your future, one wise step at a time. Dada provides educational wisdom and guidance. Always consult your registered financial professional before implementation. Investment in the equity market is subject to market risk. We do not claim any guarantee of return in equity-related investments. Thanks and regards, Kaustav Biswas, https://www.planfuture.in